Hi there, good morning. You're watching Market Cafe on ET Now with me, Snehisha. As usual with me today is Shreyansi Singh. And well, Shreyansi, lots to watch out for. But first up, this is a show where we're going to take you through everything that has happened in the market. Well, it was the big day budget for us yesterday, but the global markets were functioning as usual. So we're going to take you through everything that's happened globally as well as everything that happened back home post the markets as well. Also, we're going to take you through all the stocks that brokerages are flagging off for us this morning, as well as all the stocks that are going to be on the radars of investors this morning on the back of their individual news flows as well as earnings. But having said that, let's talk about the biggest event that happened yesterday, and that was Modi government's budget, right? Because Modi government has pledged on spending on job creation but sounds a larger call for fiscal prudence with this year's budget. Finance Minister Nirmala Sitharaman lowered the fiscal deficit target to 4.9% for the current fiscal, and that's a revision from 5.1% from the interim budget. The target will then fall to 4.5% or lower for the financial year ending March 2026. The other big figure that the street was eyeing, the capex target, which came in at 11.11 lakh crore rupees or 3.4% of the GDP in fiscal year 2025, unchanged from the interim budget levels that we did see coming in February. Additional financial fillip for Bihar and Andhra Pradesh was given, two states where BJP's PM's BJP yielded strong support. With high unemployment remaining a big and sticky challenge, the Finance Ministry has also announced a 2 lakh crore allocation towards job creation, education as well as skilling. And of course, important to note that the economy is expected to grow by 6.5 to 7% in the current fiscal, albeit lower than what the RBI is projecting at 7.2%.
Well, absolutely. And in the budget, we did see the finance minister announcing the 9 focus areas. But in addition to that, there's also been a lot of focus on the consumption boost, be it scaling also. That is also something that we saw a lot of focus coming on. But my colleague Sumit Chaturvedi caught up with Tuhin Kant Pandey, DIPAM Secretary as well as Revenue Secretary Sanjay Malhotra as they speak about the paradigm shift in the equity management space and the focus on GST simplification as well. Listen into what they had to say then.
Overall, I think in the interim budget, the FM had also, mentioned that, we're looking at a paradigm shift in the management of equity. We aren't looking at, disinvestment per se as the goal, but as a part of the overall management of equity. And if you really see, I would say, the main theme is value creation.
Simplification in GST has been a continuous agenda. 53 council meetings have happened till now, and in each of these meetings one has seen a simplification. And so goods and services which are consumed primarily by the common man, by those who are in the low and the middle income categories, the move certainly is, however, to reduce these number of rates. No, till now we have been getting a GST growth rate of about 10%, and we hope as per the budget estimates that have been given, we hope to continue to achieve this rate of about 10% for this year.
That's the word coming in from the Revenue Secretary, but we also caught up with the Chief Economic Advisor V. Ananta Nageshwaran as he discussed the impact of the hike in short and long-term capital gains tax. Listen into what he had to say.
Now, whether the short-term capital gains tax, short-term transaction tax increase, will it necessarily act as a disincentive for speculative activity or not, is something that is obviously one measure is not adequate, and if you are looking for gains in hundreds and 200% because of the embedded leverage in derivative assets, you are not going to be swayed by a small increase in the short-term transaction tax. But it sends an important signal to investors that we are concerned for them. Because ultimately, in a growing economy transitioning to a middle income status, the gains to long-term investing through direct stocks is going to be much more rewarding, much more durable than speculative investments, and that is the message that these tax tweaks convey.
All right, then that was the word coming in from the CEA to the government, but also listening to what SBI Chairman Dinesh Kumar Khara had to say about the Youth Employment and Skilling Program, as well as MSMEs that he sees as the core focus area as well.
When it comes to the youth employment and skilling, that is something which is very critical resource for the economy, how to really make the best use of such resources. And at the same time, as far as manufacturing and services are concerned, MSME is one of the core focus area, urban development, PMAY, etc. And that is something which will really give a significant fillip to the real estate sector in the urban areas.
All right, well, let's move on, talk about some brokerages that are coming in on the Indian real estate space. Now, we did see quite the number of announcements coming in yesterday from the budget on India's real estate in terms of PMAY. So that was a positive, but the one thing that Street is not really liking as of now is the hike of LTCG from, in fact, it is the drop in LTCG coming in from 20% to 12.5%. That's also a positive, but the indexation provision has been taken away. So now with this provision being taken away, how is this going to impact all the real estate players? We have notes coming in from different brokerage houses this morning. First up, let's take a look at what CLSA has to say. They say that this is negative for the short term. It's going to lead to a modest price hike as well, but it's unlikely to hit sellers who are reinvesting. They see impact of reallocating to other assets. They say it's a negative for less than 5 years with moderate price rise. It's neutral for anybody who holds property for more than 10 years with a price rise of more than 10% per annum. Now they're saying that the indexation benefit has been removed. What is the impact going to be like on realty markets? Least impact going to be seen on Bengaluru, Hyderabad and Pune. Maximum impact of this indexation withdrawal is going to be seen on markets like Delhi, NCR as well as Mumbai. This is what CLSA has to say. They're also saying that there is going to be no impact on properties with a 10 crore rupee plus ticket size coming in. So that's another point that CLSA is flagging off this morning. And also shifting focus to the Pradhan Mantri Awas Yojana scheme that was reaffirmed once more after it was announced in the interim budget. The key beneficiaries stand to be Sobha, Prestige Estates, Suntech Realty as well as Godrej Properties. This is what CLSA has flagged off. Moving on, let's also talk about what Jefferies has to say this morning about this. They see some low impact on demand. Benefit from the CGT offset will be seen when buying a house. The bulk of the demand remains end user driven is what Jefferies is pointing out. They see slightly smaller impact on speculation led demand, and they're also talking about REITs. Now REITs to benefit from a drop in the LTCG holding period is what they're flagging off. And lastly, the tax SOPs for REITs will be same as other equity tools. This is what Jefferies has also pointed out this morning. So well, yes, this is what the brokerages have to say of the indexation withdrawal that was announced in the budget yesterday.
Well, absolutely, Snehi. And the important question right now, is there anything that the property owners and property sellers have to be worried about? Listen to what Niranjan Hirandani had to say in the answer to that question then.
There is a problem for people who have properties which are more than 10 years old, and then the indexation does make a difference, and then the calculations come slightly different. But if you look at the people who are investing into property today, and they have to make a choice between investing in the capital markets and putting money into real estate, earlier there was a problem because long-term capital gains tax for the purposes of property was 3 years and 20%, while in the case of capital markets, it was 1 year and 10%. So there was a huge difference between the two. 90% of the people who are looking at long-term capital gains tax, or 97% of the people looking at long-term capital gains tax, are people who are doing between 3 and 5 and 6 years that they invest into properties for the purposes of long-term capital gains tax and benefit.
All right, that's the word coming in from Niranjan Hirandani, but India's fundamentals remain intact. That's the brokerage verdict after the union budget. But they do have mixed views about how much the announcements could spur consumption at a household level. They give a thumbs up to measures such as job creation and lower fiscal deficit. And Vinny is joining us with all that the brokerages are seeing after the budget announcements yesterday. Good morning, Vinny.
Talking about what the brokerages are highlighting, let's start with CLSA. overall budget, yes, positive in terms of the consumption story and the bonds is what CLSA is highlighting. They're saying that they're growing more confident in terms of the call that they made of the 10-year yield that will ease to 6.5% by March, and after yesterday's budget, they're more confident on that actually happening. Now, other than that, they're saying that inflation is in check. They expect RBI will be taking some rate cuts of around 100 basis points by June 2025 is the highlight coming in. So yes, keeping an eye out on that. They are happy to see several initiatives that will boost largely the urban as well consumption, as well as in terms of the employment over there. Tax changes is something for capital assets, which was a bit of a negative that came in, but they're keeping an eye out on in terms of the Maharashtra elections that will be there, state elections in October 2024. Other than that, Jefferies also highlighted that the budget it didn't deviate much from what was highlighted in the interim budget that was in Feb 2024. Several just small changes that have been made. Now, overall, the capex growth is maintained at 15%. Fiscal deficit further has reduced by 20 basis points. That's clearly a big positive coming in there. And other than that, rotation in large cap laggards, that remains an attractive theme for there. They see that incremental support coming in for job creations as well as state transfers that will be supporting the consumption story. So yes, consumption story, that's something that is expected to see a boost, and that was the focus that came in. And even Bernstein highlighted that this is surely a subsidy flavored budget is what they called it relative to the interim budget. They said that the quantum of extra allocation that came in for the household side is likely to move the consumption needle. They believe the budget was a neutral event and transpired not entirely unexpected. So most of it was already expected from the street. Obviously, capital gain tax increase, that is also a non-event that they are highlighting coming in there for the markets, and they believe that overall their view remains unchanged. They believe Nifty is quite fairly valued, and heavyweights, some of them missed those earning candidates. Small and mid cap, they see rich valuations there and should potentially be impacted primarily by the fundraising accelerating. That's the word they're keeping an eye out on. And overall, they're relatively selective in terms of stock picking. So yes, keeping an eye out on that and some of the sectors that they're keeping an eye out on.
Absolutely, Vinny, and there's lots to keep an eye on. And speaking of that, we also have the Wall Street that we need to keep an eye on. Nasdaq stock futures traded lower Tuesday night after mega cap tech companies, the likes of Alphabet and Tesla, reported their second quarter results. Now, futures tied to the tech-heavy Nasdaq moved down about 0.5% thereabout. While when you take a look at S&P 500 futures as well, you're looking at a similar downtick coming in, 0.4% downtick coming in there as well. And you do have the Dow Jones Industrial Average futures that also slipped about 0.2%. Now, during Tuesday's main trading session, then the broad market index pulled back around 0.2%, while the Nasdaq Composite as well as the Dow inched down about 0.1% each. Now, investors have largely priced in the chances of the Federal Reserve cutting interest rates at its September meeting, and combined with rising confidence in a soft landing, the market has continued its rally with rate-sensitive sectors, the likes of small caps as well as industrials, rising in the recent weeks, and that is something that we've seen emerging as a trend as well. Speaking of trends then, on the earnings front, you do have investors looking out for AT&T as well as General Dynamics and Boston Scientific's quarterly results. And at the start of the week, around 20% of the S&P 500 companies that had reported their second quarter earnings, out of these, 80% of them topped expectations. So that's the kind of trend that we've seen emerging there as well. Lastly, let's also take a quick look at what European markets did. And European stocks closed slightly higher, with investors assessing the latest earnings report from regional companies as well. When you take a look at the Pan-European Stock 600 index, you're looking at an uptick coming at of about 0.1% thereabout there, Snehi. But we do have oil prices that are staging quite the rebound there.
Absolutely, some recovery being seen on the oil front as well, because lots happening on that front. The fall in US crude inventories have caused oil prices to rebound yesterday after several days of decline, while expectations for a nearing ceasefire deal in the Middle East kept prices from continuing to climb. Let's take a look at what WTI and Brent are doing. WTI at 77.16, quite the uptick coming over there. Brent also at 81.2, comfortably above that $80 per barrel mark. 0.2% gain coming in on both of these fronts. Now, US crude oil, gasoline and distillate inventories fell last week, according to market sources citing the American Petroleum Institute, which is a trade organization. Benchmarks have picked up accordingly to this data. WTI had lost 7% over the previous 4 sessions. Brent shed nearly 5% in the previous 3 as well. The API figures showed crude stocks falling by 3.9 million barrels in the week that ended 19 July. This is what sources said, speaking on condition of anonymity, and this is to international wires. Gasoline inventories fell by 2.8 million barrels and distillates shed 1.5 million barrels. Now that would be the first time crude stocks in the United States fell for 4 weeks in a row since September 2023. Now, the official data on government data on oil inventory data is due for release this morning US time, and oil prices fell to a 6-week low yesterday, with the Brent closing at its lowest level since 9th of June on ceasefire talks between Israel and Hamas in a plan outlined by US President Joe Biden in May and mediated by Egypt as well as Qatar. Prices also suffered on continued concern that economic softening in China, which is the world's biggest crude importer, would weaken global oil demand. So that was on the oil front. Lots happening on the geopolitical front, as well as the demand and supply picture, which we'll have a clear idea of once the data from the US is out today. But let's just talk about gold. Gold prices have edged up yesterday, set to break a 4-day losing streak as investors awaited US economic data, which is due later this week. For more clarity on the timing of the Fed Reserve's expected rate cuts, spot gold was up 0.2% as well.
Well, absolutely. And let's move on then. EV discounts and AI costs dented Tesla profits. Let's take a look at what the earnings looked like. Tesla posted weaker than expected earnings, marking the electric vehicle maker's 4th straight earnings miss, the first time for the company. Adjusted operating margin shrank to its lowest in 3 years in the second quarter. Profit also missed Wall Street estimates, pushing the stock down by 8% in extended trading. Meanwhile, deliveries of their most popular electric vehicles have been dropping this year, and the company has responded by slashing prices as well. So that's the roundup coming in for Tesla.
Let's keep it going with earnings then. Google parent company Alphabet has reported second quarter results that were in line with analyst estimates on revenue and earnings, but missed on YouTube advertising revenue. Revenues were up 14%, driven as search as well as cloud, which surpassed $10 billion in quarterly revenues and $1 billion in operating profit for the first time.
Alright, and that was your daily dose of morning news to go with your morning coffee. But for now, let's take a quick break. When we come back, we'll take a look at how the Asian markets are faring, so you don't go anywhere.
Hi there, welcome back. You're still watching Market Cafe on ET Now. Let's take a quick look at what the Asian markets are up to this morning. How have those markets opened? Asia markets largely fell this morning as traders assessed July business activity data from Australia and Japan. Tech earnings from the US also did not help much. You have Japan's Nikkei that dropped 0.2% on open, as of now continues to build on those losses. More than 0.3% lower is where Japan is trading at right now, because you had flash data from the All-Japan Bank that showed that the country's business activity returned to growth, but Japan's Composite Purchasing Managers Index, which is the PMI for July, was at 52.6, up from 49.7 in June, so which is a good thing coming in, but the markets are not penciling that a lot as of now. 0.3% lower is where Nikkei is. In contrast, when you take a look at Kospi opened with a gain of 0.1%, not much, but well, continues to be flat, not much movement coming in on Kospi as well. The South Korean electronics company is still grappling with a strike from its largest workers' union, with talks on Tuesday yielding no results. And this is what has led to some pressure being seen on the Kospi as well. But as of now, rather flat, not doing much. Shifting focus, let's talk about Australia's ASX 200 that slipped 0.2% on open. Looks like it has slightly improved from that mark, but in the red with a slight negative bias nonetheless. This is after the country saw its private sector activity expand at a slower pace in July, with the composite PMI dropping to a 6-month low of 50.2 compared to 50.7 in June, according to Juno Bank. Let's also take a look at what Hang Seng and Shanghai are up to this morning. You have Hang Seng also largely flat, not much to worry about when it comes to Hang Seng, very flat with a very mild negative bias coming in. Shanghai also same can be said for Shanghai, 0.1% lower, so not much happening on this front as well. Very subdued cues coming in, if you'd ask me, rather from the Asian markets. But when you should focus back home and take a look at what the eventful day that we had yesterday and where the Nifty shut shop, around that 24,480 mark is where we closed for the day. Implied open as of now at 24,402, indicating a slightly subdued start from where we closed yesterday. So well, yes, that's what the implied open is indicating, but Asia looking largely mixed as of now, trading with a slight negative bias.
Well, absolutely. And let's take a look at some more interesting updates coming in. Then Bhutan's King Jigme Khesar Namgyal Wangchuk, as well as Prime Minister Dasho Shering Tobge, toured Adani Group's flagship projects in Mundra and Khavra. In Gujarat, Gautam Adani expressed gratitude, highlighting the collaboration for sustainable development. The visit aimed to explore joint opportunities across sectors, the likes of hydropower, renewable energy, as well as urban development. This initiative underscores Bhutan's commitment to eco-friendly projects and Adani's role in regional growth as well as energy security. The discussions mark a step towards enhancing bilateral ties and fostering a greener future. Welcome back. Thank you so much for staying tuned in. Well, let's get a little more stock specific then. Tata Consumer announced a rights issue worth 3,000 crore rupees at a discount of about 35% to the current price. And the last day to buy to be eligible is tomorrow. So should investors consider the rights issue? And what are the options available for them? Somit is standing by with an explanation.
Well, Tata Consumers would be in focus given the fact that the company has announced its first ever rights issue. The company is looking to raise close to 2,998 crore rupees, and the rights issue price has been set by the company at around 818 rupees, which is at a discount of nearly 35% compared to the current market price. Now, the ratio the rights entitlement is that for every 26 shares held in Tata Consumers, the shareholder would get one rights equity share at a price of around 880. Now, the record date for this rights issue has been set at 27th of July, but given the fact that it's a Saturday, the last day to buy shares to be eligible for this rights issue would be July 25th. Now, the rights issue would open on August 5th and would close on August 19th. Now, if you are eligible for the rights issue, the rights entitlement would be credited to your account on August 4th, and one can trade and sell this rights entitlement till from August 5th till August 12th. Now, what is a rights entitlement? Rights entitlement is a temporary credit of the shares, and investors can choose to either keep the RE and subscribe, or else they can go ahead and sell this rights entitlement in the open market on both the exchanges, that is BSE and NSE. Now, what should an existing or old investors do? Now, they can consider selling the RE when they get credited into your account, because the estimated RE price as the rights entitlement price is expected to be around 439 rupees, and assuming one has around 26 shares, then they will get one RE which will be valued at close to 439 rupees. So, if you sell this share and get that amount, then it would translate into a dividend per share of nearly 16.9 rupees per share. Now, do remember that Tata Consumer has never announced such a big dividend. The highest amount of dividend that they had announced was of 8.45 rupees per share in the past. Now, if they choose to keep this RE, then there is too much of hassle. They need to keep a track of the payment, and if they miss that payment date of this rights issue, then the rights issue will then their RE would be forfeited, and they would not be able to realize any gains out of this RE. Now, what should new investors do? However, given the fact that the rights entitlement is not too much in favor, there is no trading or arbitrage opportunity for any new investors. So, if they go ahead and buy RE for arbitrage opportunity in Tata Consumers, then that won't happen. They will in fact incur a loss by buying Tata Consumer shares just for arbitrage purpose, keeping in mind the rights entitlement or the rights issue that will be opening.
All right, Swami, thank you so much for taking us through that. Tata Consumer will be focused on the back of that, but let's get a move on then. And the capital gains tax hike was reasonable. That seems to be the street verdict on the budget. The ace investors, Vallabh Bhansali, Hiren Ved, Prashant Khemka, Nilesh Shah, as well as S. Naren, believe India's growth story remains intact while valuations remain high. Listen into their views.
The levels at which our market was trading, they were due for a correction and a pause. We at the most get a pause, but the trajectory, as I said, I've looked at much higher taxation on capital gains and things like that. We have moved on. If I make profit and I pay a little tax or a little more tax, makes no difference. Making profit is not easy. As long as the profit-making potential of our assets, of our country, of our companies is only being enhanced, whether you pay small fraction or a slightly bigger fraction makes no difference.
Hope this is probably, from here on is a stable tax rate. If that is the case, then I think, markets in the past have also adjusted to new realities. It's not the extent, but it's more the principle.
Going forward, to expect indexation benefits to come in for equities becomes less likely, and so it's just a bit greater uncertainty going forward, I would say, on tax front, in addition to the higher taxes. So I think for investor behavior to change, it would require necessary condition would be poor returns from equity markets, in my view, or substantially inferior returns from the compared to the bond markets. Absent that, I don't think the flows or investor behavior would change or would precede the returns.
The fundamentals have actually improved with fiscal consolidation, with investment focus continuing, and hopefully with better employment generation, this growth is likely to sustain. So the valuation impact on the market will be far more from the budget than the diluting effect of increased taxation. So overall, India growth story continues, and tips की जगह पे सिप्स ही करिए.
By reducing capital gains tax on real estate is a very interesting step, because if you look at equity market, you have huge volumes of transactions, and people sell maybe what they own maybe every year. Whereas in real estate, because capital gains tax and the frictional cost associated with transactions have been very high, they have not been selling what they own for years. Certainly invest in debt, and that's, or in asset allocation. That's what we call it. And I think it is absolutely imperative that they should invest in asset allocation and not in equity at this point of time. But having said that, people have just totally ignored debt at this point.
All right, there you have it. So that's the verdict coming in on capital gains tax when it comes to what investors had to say. But let's also shift the spotlight to a blockbuster Q1 for AG's Transact, as the company turned profitable after 6 quarters of losses. So what are the key triggers for AG's Transact going forward? Sharad is joining in with all the number crunching. Sharad, it looks like it was quite the dhamaka Q1.
Well, it's a turnaround quarter coming in for AGS Transact, and if you look at it, the revenues might have dipped on a year-on-year basis, but if you look at the sequential numbers as well as year-on-year basis numbers, for the EBITDA numbers as well as the margins numbers, they have been very strong, and also the company has turned profitable after almost 5 to 6 quarters of losses which the companies had posted. Strong performance is coming in from the banking solutions business overall, and recently the company did raise almost 200 crores in preferential round also last month, out of which 150 crores was contributed by the promoters, and HNI investors and marquee investors also took position in it. Now going ahead, the triggers for the company, this includes large SBI ATM orders. They are expected to be completed by H1 FY25, and interestingly the new product launches are expected to kick in, and Street is bullish on, especially in the digital payments business. Lastly, an important trigger is that the company is shifting from its transaction fee model to a mixed model, and that's what the Street is expecting, is that higher margins and realizations could happen because of the shift of charging policy.
Thanks for all of those updates coming in on the AGS Transact front. But on that note, we'll slip into a very short break on this edition of Market Cafe. More stock-specific news and updates when we return, so you stay tuned. Hi there, welcome back. Let's talk about some earnings that trickled in yesterday. And while we were very busy and occupied with the budget, you did have Nifty major HUL coming out with its numbers yesterday. HUL, or Hindustan Unilever, delivered an inline set of earnings for Q1. Let's take it across to Winnie to get a fine print of the numbers. And Winnie, help us understand what these numbers were like. Break them down for us.
So absolutely, while overall revenue and profits came in line, margins also were as expected, 23.5%, but volume growth, that's the story that we're watching out for, right? You know, remaining at the 2-3% level for the last year, we've seen finally volume growth seeing an improvement and seeing a pickup. So volume growth was better than what the Street was expecting. Around a 4% volume growth, underlying volume growth is what the company reported. So that was one of the major key highlights. Other than that, rural demand, that started seeing a gradual improvement. That's the word that's come in even from HUL's management. Premium segment, that is continuing to do well. And in terms of commentary, they said that EBITDA margin will remain at current levels. The company is focusing on ad spends. They're focusing on improving their gross margins, but EBITDA margin will sustain at these 23% levels. 23.5% is what they reported this time. So around these levels is what they expect the EBITDA margins to sustain at. Now in the press conference, they also highlighted that the rural grew faster than urban in Q1 FY25. They expect a low single single digit positive growth in terms of overall pricing growth for FY25 by the end of the year FY25. And overall, raw material inflation has currently been deflationary. We are not seeing much of an inflation there. They're focusing on competitive volume growth, as well as overall, they want to focus in terms of the ice cream business as well. The management commentary came in that in terms of decision for the ice cream business, by the end of FY25, we will know what is the decision going to be coming. Now, on the back of that, brokerages surely have raised the target price for the company. So, consensus in terms of the target price that you're seeing, overall consensus rating has increased and target price is at 2,719 rupees. In ICICI Securities has increased the target price. We're seeing Nuvama increasing the target price, as well as Investec and Goldman Sachs. All of them too have increased the target price. And Nuvama has given a target price of 3,375. Previous price was 2,885 rupees. So surely an increase and a positive thumbs up coming in terms for the target price for HUL. Though let's not forget, HUL has already seen a run up, so we'll watch out for how the stock performs.
Well, absolutely, Vinny. Thank you so much for joining us with that roundup. Well, as promised, let's also take a look at stocks that you should keep on your radar. And we have Jinay joining us in the studio. Jinay, tell us which are the stocks that are making it to your list bright and early this morning then.
Well, yes, on the back of earnings, Schaeffler India will be in focus. Company reported a good set of numbers. Revenue saw an uptick of about 15% coming in at 2,107 crores, whereas the net profit saw a marginal improvement of 3.5% coming in at 245 crores versus 237 crores year-on-year basis. Moving on, Thyrocare Tech also reported good set of numbers. Revenue stood at 157 crores, seeing an uptick of about 16%, whereas net profit coming in at 24 crores versus 17 crores year-on-year, improvement about 40% year-on-year basis. On the flip side, keep your eyes on Parag Milk Foods. The company reported weak set of numbers compared to expectations, though the revenue saw an improvement of about 1% coming in at 758 crores, and net profits also saw an improvement of about 27%, but still lower than what the street was expecting. Moving on, Titagarh will be in focus as company has begun expose of its traction converters with its first shipment to Italy. It is worth around 65 crores. Moving on, Infosys will be in focus as company's innovation fund has collaborated with UVC partner. They will be investing about 5 million euros for the same. And lastly, Bajaj projects will be in focus as company has backed orders worth 586 crores from Power Grid Corporation.
All right, Jinay, thanks so much for joining us in the studio bright and early this morning with a list of all the stocks that could be potential buzzers in today's trade. But let's keep it going with all the stocks to watch out for, because now we also have my colleague Gaurav who's joining us to talk about the stocks that brokerages are flagging off this morning and what they have to say. Gaurav, good morning. Take it away.
Yes. First, let's talk about Keystone Realtors, because Investec has initiated with buy rating and a target price of 875 rupees per share. What they believe is that this company is going to be a key beneficiary when we talk about redevelopment projects happening in the MMR region. They have asset-light model, which is again going to support the business. And lastly, when we talk about the ratios like collection ratios and average realization, that is also better for the company, and that is why they are being a little bullish on this company. Next, let's talk about Kajaria Ceramics, because Jefferies has now maintained buy rating and hiked the target price to 1,590 rupees per share. If we talk about the results were mostly in line with what the street was expecting, and margins were a little better than the estimates that Jefferies had. And on back of this, now they have retained the estimates of around 11 to 12% volume growth for the next 3 years for the business. And what they believe is that near-term hiccups may remain for the company, but the medium-term triggers are going to impact positively for the company. And lastly, let's talk about ICICI Pru, because Macquarie has now maintained neutral rating and a target price of 580 rupees for this share. What they believe is that when we look at the results, the good thing about the result was the AP growth, which was in line with what the street was expecting and on a positive side. But when we talk about VNB margins, those were a little weak for this quarter for ICICI Pru, and that is why they are being a little neutral on this company, maintaining the target price of 580 rupees per share for ICICI Pru. So definitely on back of the brokerage notes, we'll be watching out on all these stock counters in a day-to-day.
Well, absolutely, Gaurav. So we'll keep an eye on all of those counters, but Axis Bank is also all set to report its Q1 numbers. Moderation in NIMS is likely, while an uptick in NII as well as PAT is also on the cards. So tell us what the street is really penciling in there as well.
Well, yes, when we talk about Axis Bank, that is going to come up with their Q1 results today. And when we look at the street's estimate, now they're expecting net interest income to increase almost by 12% on a YY basis. We may see higher OPEX cost and at the same time high fee income, which can actually weigh in on PPOP. And that is why we may see and expect, PPOP growing up at 10% on a YY basis. When we talk about profitability, there also we may saw 10% increase in the PAT for the company. Talking about the net interest margin, now street is expecting this net interest margin to to moderate a little, almost by 6 basis points, and that may come somewhere near 4% because of the higher cost of fund that we may see in this quarter. Management, let's not forget that management also is expecting repricing in the cost of funds, and that may stabilize in 2Q FY25. Apart from that, when we talk about advances and deposits, now Street is expecting 15% increase in terms of advances and as well as deposits for the bank, and they are not expecting any kind of change when we talk about LDR ratio, which is currently at 90% for the bank. When we talk about asset quality, they do not see any kind of concerns for asset quality. What happens is that in Q1, technically, bank shows some kind of moderation in asset quality, and that is why we may see increase in slippages, and that may impact NPAs. But again, that is all factored in, so no negative surprises what the Street is expecting from Axis Bank in terms of asset quality. And lastly, what we will be watching out from the management is that any kind of commentary coming up on the cost normalization, any kind of commentary in net interest margins, because also let's not forget that in Q4 management had said that the net interest margins will be maintained at a healthy level. And lastly, any kind of commentary on the OPEX side, because management had said that they will be increasing the branch expansion almost by 500 branches in this year, and on the back of this, any kind of OPEX growth that they're expecting will be a key to watch from management.
Alright, so lots to watch out for from Axis Bank's numbers, but largely no negative surprises is what the street is expecting. So Gaurav, thank you so much for that. Let's keep it going with earnings then. Let's talk about another nifty company that's expected to come out with its numbers today, and that is L&T. Net profit is expected to jump 20% on a year-on-year basis, but it's the EBITDA margins that are expected to come under pressure. My colleague Ria, who tracks that company closely, is joining us to tell us what the street is expecting and what we can hope to see from L&T's Q1 numbers. Ria, take it away.
Yes, well, L&T is expected to come out with their Q1 FY25 earnings today, and the street is expecting a 12% year-on-year growth in the revenue, but a 20% decline on a quarter-on-quarter basis, because Q1 is a seasonally weak quarter for the industrial sector as a whole, and we're also expecting some weakness in the execution and order inflow this time around due to the general elections, the higher temperatures, labor constraints, and also due to a high base in the previous quarter. Although we are expecting to see some pickup in the thermal ordering segment because of the huge power demand this time around. The ordering activity is likely to pick up from Q2 of FY25, and this time around margins are also expected to remain under pressure due to low order execution. The key monitorables that we're looking out for though are the working capital, the margins in the infra segment, the domestic order pipeline, and the management commentary on the order execution. And we're also watching out for the execution ramp up in the Saudi projects and how the Middle East pipeline is shaping up. And lastly, we're also keeping an eye out to see if there will be any revisions to the FY25 guidance that was given in the previous quarter.
Alright, then thanks Ria for joining us with that update then. And even after this hike in long-term capital gains tax that we saw being announced yesterday, the markets did not see a big fall coming in. We spoke with market experts as well as veterans to understand the rationale behind it. Take a look at what they had to say then.
I think my view is it doesn't matter the increase in long-term capital tax from 10 to 1.5%. The longer the period you hold, it becomes a fraction of your income. So therefore, that's not something one should bother about it. I think SIP culture that got built in the last few years, and SIP way of investing now has become a way of investing in the capital market. Definitely would have to be continued. I think would continue.
I think there has been a lot of noises over the last couple of months in terms of the rising interest in F&O speculation, and I think something was expected from the government and regulators to address that. But to promote the long-term investments, I think market wasn't expecting much change in the long-term capital gain tax.
Macro environment for these corporates or the companies where you have invested in, whether they can grow well and create capital gains for you is most important. I think market has become very matured. That's the reason it did not react very badly for this capital gain tax increase. And everything is all is well in the market.
We started with no expectations in terms of changes in capital gains, and therefore this small increase in capital gains tax is definitely not welcome. And the other thing is there are some uncertainties regarding the buyback tax. Obviously, STT has got increased. I am hoping that it is only for speculative transactions, not for delivery transactions, because the whole purpose of STT was in lieu of capital gains tax. So now we have capital gains tax as well as STT. But all said and done, if you are looking at a 15% return going forward, a change of 2.5% in long-term capital gains tax reduces your your returns by maybe 30 basis points. So we'll have to work hard to make 30 basis points more than the 14-15% we were making. It's as simple as that.
My fundamental story, long-term story for India is still intact. So I'm not too bearish on the country just because this is one budget event. My profit has come down, to be honest. That's what has happened. But it's not something which will shake the market and then the confidence in the country. So the budget hasn't done anything fundamentally wrong.
All right, so minimal impact coming in from the capital gains tax that has been hiked is the word coming in across the street from market experts and veterans. But on that note, we'll bid you goodbye on this edition of Market Cafe. From Shreyansi, me and the entire team that put this show together, thanks so much for watching. But as while we bid you goodbye, you still stay tuned to the channel because the market takes all the action forward.
If you like this video, then like, share and subscribe to ET Now.